Hi there, everyone. Thank you so much for joining us this evening. My name is Amy Lewis, and I have the privilege of working with hospice and community care. As we get started here, just a few items of housekeeping. The first notice is that everyone will be muted throughout the presentation. However, if you have a question, Ben will be answering questions throughout the presentation, and we'll save some time at the end of the presentation for Q&A. Just use the chat button at the bottom of your Zoom screen. You can either put your name in there or a full question in there, and we'll make sure that that's addressed throughout the program or at the end of the program. With that, at the end of today's presentation, we will be sending you the contact information for Ben, as well as the PowerPoint slides that I'll be sharing with us this evening. So you will be receiving those via email following the presentation. And with all of the stuff out of the way, please join me in welcoming Ben Atwater as he presents Analyzing How America Invests. Ben Atwater and Matt Malik founded Atwater Malik in 2008 as an independent registered investment firm. Their vision of the firm is to offer transparent investment approach, unbiased wealth management advice, and an unparalleled level of service. Attracting clients solely on a referral basis, Atwater Malik has experienced significant growth and attracted a wide range of mass affluent and high net worth clients throughout the country. Before launching Atwater Malik, Ben gained extensive experience with wealth management and Fulton Financial Advisors and Bank of New York Mellon. Ben holds an MBA from Lebanon Valley College and an undergraduate degree in finance from Miami University. Ben's also very actively involved in the Lancaster community through a wide range of organizations, including serving on the Planned Giving Council here at Hospice and Community Care. Please join me in welcoming Ben Atwater today.
Thank you, Amy. It's good to be here. Thank you, everyone, for joining us today. As Amy indicated, I'd love to take questions at any time, so feel free to ask. And I'll try to take a little pause between each slide to give you guys some time to ask questions. So with that, we'll just get right to it. So this presentation is called How America Invests, or Analyzing How America Invests. This was based on sorry, I think someone went off mute there for a second. This is based on a study that Vanguard conducted. And we'll look at the next slide and review the data set that Vanguard used. So basically what Vanguard did is they looked at 800,000 affluent retail investor households, and they looked at 5 years worth of data, 2015 through 2019. And as we can all attest, that's been a period of generally robust market growth. Not only stocks, but bonds have done well over that period of time as well.
I think, sorry about that. We're just having a quick technical difficulty. Let me just stop sharing for a second and get these slides back up. Thanks for your patience, everybody. You'd think after this much time on Zoom that I'd have these down. Thank you, Ben. Sorry about that.
That's not a problem. So I think we want to go to the, yeah, there we go. Okay, back up one. Okay, there we go. So as we all can attest, that was a pretty good period for markets, 2015 through 2019. So this study hasn't really looked at terribly tough times in the market. However, the study did go back and revisit the first quarter of 2020 when COVID initially hit. So we do have a little bit of data on how people reacted to a unique situation, and we'll cover that toward the end of the presentation. There are some limitations on the study. The study was just an aggregation of data. So, and it's only data that Vanguard has on their own clients. So very likely people have assets outside of Vanguard. They may have a bank account with a large balance. They may have a workplace retirement plan with a large balance. They may split their assets between Vanguard and other advisors. So we don't necessarily have a complete financial picture for everybody whose data we have. We just have the data we have through Vanguard. And the study is just kind of means and averages. The study doesn't necessarily take into account people's goals. So for example, if someone's sitting on an extra large amount of cash because they're planning on buying a vacation home, it's just going to reflect as a large cash balance. It's not necessarily going to reflect that particular goal. Or if an older person is investing really for their children and grandchildren because they have enough money to live off of and they don't plan on pulling from their investments, then they'll probably be more aggressive than someone who's older, who's living off their investments. So again, we don't necessarily know people's goals for their particular accounts. It's just an aggregate amount of data. So there's a couple of limitations, but the data is really good nonetheless. And I think kind of probably washes out at the end of the day. So let's look at the average household that was studied here. The average balance of a household was $1 million approximately. The average household size was 2 people. The number of accounts was 3. The number of different investments that they were invested in were 9. Remember too that Vanguard's primarily a mutual fund company. People think of Vanguard and know Vanguard as an index fund company. So it's not a place where people own a lot of individual securities, which obviously would limit the amount of holdings. 9 mutual funds it's a fair amount of holdings, whereas 9 stocks isn't very many holdings. So we have to remember that the data does come from fundamentally a mutual fund company, fundamentally an index mutual fund company. The average account tenure is 21 years, which is really pretty extraordinary. These households have been with Vanguard for 21 years, and the average client age is about 66. So across the board, how people were invested, sort of not surprisingly, is a balanced portfolio. 64% in equities, 23% in fixed income or bonds, and 13% in cash. This is pretty interesting almost in that it's not interesting because it's exactly maybe what we thought it would be. Just a very typical balanced portfolio. So I think it's kind of remarkable because it's not remarkable. It's not a surprise. Balanced portfolios tend to work very well for people. If you look at the average age of 66 in the study, that's probably a really good place for a 66-year-old to be. Balanced between stocks and bonds. Obviously, in a quote unquote balanced portfolio, you always have a tendency to overweight stocks a little bit because stocks over a long period of time are the higher returning asset class. And in an environment like today where interest rates are just so low and there's just not much return available from bonds, people tend to overweight equities a little bit. So we thought that 60-40 mix made a lot of sense. Obviously, a lot of it is age-based though. And again, remember the data is skewed a little bit because the average age in this study is 66. But if you break it down by age, the average allocation to equities or stocks for a 25-year-old was about 90%. Again, very appropriate, what almost any financial advisor would recommend, that if you're that age, you should be 90, 100% in stocks. Obviously, you should have a reserve fund, you should have a rainy day fund. But other than that, you should probably be very aggressively invested in stocks at age 25. And really the same goes for age 45. You should probably have a pretty aggressive allocation to equities. You're still 20 years from retirement and hopefully, 40 or 50 years or more from the end of your life. So you want to be investing aggressively at age 45. Then at age 70, the median allocation is 60%. Again, that sort of balanced portfolio. The thing that was probably most interesting about the data in terms of asset allocation and percent allocated to equities versus bonds is the idea that at age 70, the equity allocation basically stabilized. It doesn't glide lower. You would think as people get older, they're going to continue to reduce their equity exposure. It didn't happen in this data set. I think there's a number of reasons for that. One, I sort of alluded to before, interest rates are really low. So people just don't see that much return potential in bonds, and therefore they're overweight stocks. And I think the other reason for this is it is affluent households generally. And a lot of these people may not need the money that they're investing. They might not need it for their lifetime. They may really be investing for children and grandchildren. So I'll take a quick breath here and before we flip to the next slide and just see if there's any questions out there that we can address before we move on to sort of the next topic.
There is a question, Ben, and the question is, do these allocations of equities change as you near retirement regardless of your age?
So all of these portfolios are either advised by the person themselves. So, person X has an account at Vanguard and they make their own investment decisions. Or Vanguard Advisors has an advisory service, and these accounts are also part of Vanguard's own advisory service. So if you're with Vanguard's advisory service, as you get older, depending on your goals, they're probably going to recommend you reduce your equity exposure. If you're investing on your own, you may or may not reduce your equity exposure. Very few people in this particular study use target date funds or use any kind of a fund that automatically adjusts as you get older. So more and more today, especially younger people in 401ks, they're using what we call target date retirement funds. And these target date retirement funds basically take your age into consideration and when you're going to retire. So if I think I'm going to retire in 2045, I have a 2045 target date retirement fund, and that fund is managed to slowly decrease your exposure to risk over time. Those types of funds were not very prevalent among Vanguard's affluent households.
I'm not seeing any other questions, so.
Okay, super. Let's flip to the next slide. Okay, some miscellaneous facts outside of just the stock and bond side of it. Investors are using a mix of active and index in their portfolios. And those investors who use more of a mix between active and index actually have a higher average balance. It's kind of an interesting thing too, because Vanguard is traditionally thought of as an index fund type of company. So the fact that 43% of portfolios include an active strategy, that's probably higher than I would have thought. And interestingly enough, because people that mix active and index have a significantly higher balance, it sort of raises the question, do they have a significantly higher balance because they mix active investing and index investing, or do people that just have a higher balance tend to buy more different kinds of investments? I think it's probably the latter. I think as you have more wealth, you tend to just acquire different types and more types of investments. So I think the correlation and the causation there is really more that people that have more money tend to buy into multiple strategies. And even at Vanguard, 7% of all portfolios are all active, which includes no index funds at all. Again, that was a pretty surprisingly high number for me, just given Vanguard's reputation. At a place like Fidelity, where they're more known for their actively managed mutual funds, or T. Rowe Price, where they're more known for their actively managed funds, these percentages may be flipped. I have no idea, but they could very well be. The index share is highest among younger investors, and it declines with age. Again, the cause and effect there, who knows? Probably as people get older and they have more money, they probably tend to acquire more in different types of investments. Younger people probably tend to have one investment, and that might just be an S&P 500 index fund. However, over the years, indexing has become more and more popular, and it has become more and more popular among younger people. So there's probably some cause and effect there as well. About 18% of the allocation is international, and that includes stocks and bonds. So international stock exposure, I believe, was around 15%, or 14%. International bond exposure was around 3 or 4%. 5% of portfolios are invested in actual individual securities, individual stocks and bonds. Probably, again, a higher number than I would have thought at Vanguard. 1 in 4 households use exchange-traded funds. There are a lot of households that Vanguard refers to as exchange-traded fund enthusiasts. So those households will use 1 or 2 or 3. If you use 1, you tend to use more exchange-traded funds. And then people that don't use them, don't have 1, tend to have 0 and just aren't interested in them. And again, very appropriately, Roth IRAs exhibit the highest allocation to equities. A lot of planning that's done anticipates that people are not going to spend their Roth IRAs, especially higher net worth people. That those are assets that will be passed on to children and grandchildren. Therefore, if you're not going to spend the money during your lifetime, you're going to be more aggressively invested, try to maximize the tax deferral of Roth IRAs, try to be as growth oriented as you can in Roth IRAs. And so that again makes sense. As a financial advisor, so much of this data just makes a lot of sense. And it's just kind of good to see that, at least among high net worth households at Vanguard, people are seemingly doing the right thing.
Ben, could you elaborate a little bit on what exchange traded funds are?
Yeah, absolutely. So exchange traded funds are sort of analogous to mutual funds. They're a pooled investment vehicle. The thing that's different from them in mutual funds is that exchange traded funds can be traded like a stock during the day. So a mutual fund can only be bought and sold once a day at the end of the day based on the 4 o'clock closing market prices. So if you own a Vanguard index mutual fund at 4 o'clock, you're going to get the price, whether you buy or sell that day of the fund. And you can only get in and out of it one time per day. If you own an S&P 500 exchange traded fund, you can sell it at 11:03 a.m. and you can buy it back again at 12:02 p.m. and you can sell it again at 1 p.m. So it's just like an index fund in that it models some sort of an index generally. It's a basket of securities, but it just trades during the day like a stock does versus only one time a day like a mutual fund. And exchange traded funds have only become popular, and I'd say, I've been doing this for 20 years. We didn't think about or use exchange traded funds 20 years ago. They've become more popular in the last decade, I would say. They probably existed 20 years ago, but nobody used them. Any other questions as I take a little quick pause here?
I'm not seeing anything else or any hands go up. If you do have a question, feel free to unmute yourself and ask the question as we go along. That would be fine too.
I have a question. Could you elaborate a little bit on the difference between active and what was the other one?
Yeah, passive or index? Sure,
Thank you.
I'd be happy to. So an index fund is based on an index, like the S&P 500 is the most popular index.
Mhm.
P500 is by and large the 500 largest companies in America. Not exactly, but it pretty much is the 500 largest companies in America. And the largest company has the biggest weight. So Apple is the largest company in America, and the weight of Apple in the S&P 500 is say 5 or 6%. So 5 or 6% of the S&P 500 is Apple. And so if you own a S&P 500 index fund, 5% of your investment is going to be invested in Apple. The other big holdings in the S&P are Google and Facebook and JP Morgan and Berkshire Hathaway and all kinds of big companies that you've heard of. And whatever their weighting in the index is, and their weighting is based on what they call market capitalization. So that's basically the number of shares outstanding times the price of the shares. So what's a company worth? Like a company like Apple's worth something like $2 trillion. And that's much bigger than almost any other company. Companies like a Kellogg's or something like that are worth, 20 billion or 30 billion or something in that range, say 10 billion or 20 billion or something along those lines, whereas an Apple's worth 2 trillion. So in an index fund, you're talking about the 500 largest companies. A Kellogg is in the S&P 500 index. But if you own an S&P 500 index fund, you own a very small weighting in Kellogg and a pretty large weighting in Apple. Actively managed portfolios, on the other hand, the manager, whoever manages the portfolio, chooses whatever stocks that they want to choose within certain guidelines. But generally speaking, they just pick the stocks that they want to pick in their sort of style. So as a fund manager, I can buy Apple or not buy Apple. If I own an index fund, I'm going to own Apple. If I own an index fund, I'm going to own Google. But if it's an actively managed fund, I might not own Google. I might own something else. I might not own that at all. So that's the difference. One is sort of managed by a human being who picks stocks. That's the active. The passive is managed basically by a computer based on an index.
Okay, thank you.
Sure.
The next question that we have is whether or not the ETF holds greater risk.
Theoretically, I think that it does, and it depends on what part of the market you're in. There were some smaller, sort of esoteric, unique ETFs that I can remember sort of blowing up during the financial crisis. There's some ETFs that use a lot of derivatives to try to like go double long an index, like do twice as well as an index on a given day, or if an index goes down, goes up, and when the index goes down, the ETF goes up. There's all kinds of leveraged ETFs. There's all kinds of really esoteric ETFs out there that can collapse, and a number of them have. That tends not to happen with mutual funds as much. But like a standard S&P 500 exchange traded fund versus a mutual fund, it's definitely more risky because you can have trading issues during the day that can resolve themselves by the end of the day, but they can happen during the day and you can just get unlucky. And, you know, there's these things that happen now, they're called fat finger errors, where someone literally accidentally or a computer accidentally sends a huge trade and the stock market will like plunge for, you know, a minute. This has happened 3 or 4 times in the last 10 years. Like it'll just plunge for like 1 minute or a very short period of time, and then it'll just kind of go right back. And sometimes that can mess up an ETF. And if you're trading the ETF at that time, so I think all things being equal, they are riskier.
Okay. The last question that we have right now is approximately how many different investments should be held within a $1 million portfolio, and specifically investments of mutual funds or ETFs, not individual stock? And then how does that look different from a $200,000 investment portfolio?
I think a lot of that is just up to people's own taste and their own view of things and how they like to do things. There's very large mutual funds. Vanguard, for example, has a fund called the Star Fund, which is a balanced mutual fund. It's a fund of funds. It owns a bunch of other Vanguard funds. So the Star Fund is probably around 60–70% stocks and the rest in bonds and cash. And that fund probably owns, you know, say 12, 15 underlying funds. So it's going to have large cap US exposure. It's going to have all different kinds of diversification. So you could literally invest a $1 million portfolio in that one fund if you wanted to. Most people don't do that because, again, most people tend to think that, you know, you should have some US exposure. You should have some international exposure. So right there would be, let's say, 2 funds. Then you should have some bond exposure, some core bond exposure. And then maybe you should have some inflation protected bond exposure. So there would be 4 funds. You know, I think you can build a really, really good portfolio with 4 funds on up. I think the biggest mistake people tend to make is they tend to buy too many funds. You don't need very many. You should try to keep your process as simple as possible, especially in 401ks. Over the years, I've seen that seems to be a really big mistake that people tend to make, they just have too many funds in there. They'll end up with a dozen funds and little positions in them, and funds that they were putting money in and they are no longer putting money in. Simple is always better, no matter how much money you have. I think that's my opinion.
That's all the questions we have for now. I think I'm on the next slide for you.
All right, super. So extreme portfolios here. Again, a little bit more on asset allocation, a little bit more on what Vanguard's calling extreme portfolios. So 3% of the portfolios that Vanguard looked at have no equities in them at all. And they're considering that to be extreme, no equities. Accounts that hold more than 98% equities, they're calling those extreme too, and about 10% of accounts are effectively all equities. And again, these accounts in this study, or these relationships in this study, included advised investors, the people where financial advisors at Vanguard are actually working with you, and also people who are just investing on their own. So less than 1% of advised investors held extreme portfolios, while 14% of self-directed investors held extreme portfolios. Again, makes sense, right? If you're with an advisor and they're using modern portfolio theory and they're following quote unquote best practices, they're probably not going to have you 100% in stocks or 0% in stocks. They're going to try to have you in some sort of a balanced approach. Whereas if you're doing it yourself, you might be rolling the dice a little bit. You might have stronger opinions about where things are going or where the country's going or whatever it might be. And you may be all stocks or you may not be in stocks at all. A third of investors with the simplest portfolios, and the simplest portfolios, they're defining as portfolios that don't have very many investments in them. Of the simplest portfolios hold extreme investments compared to 4% of investors with complex portfolios. So again, the more money you have, probably the more investments you have, probably the less extreme you're going to be. Probably the less money you have, the fewer investments you're going to hold, and the more extreme those investments are going to be. And there's nothing necessarily wrong with that. If you're 25-year-old and you're saving for, in your first couple of years of saving, and you have one S&P 500 index fund, that's fantastic. That's probably all you should have. Extreme allocations were highest in households with taxable only account types. So I think what that means is that, we're probably getting that's probably part of the sampling problems with this particular study. If you only have a taxable account there, if you only have like a brokerage account there, that means basically you don't have an IRA there, you don't have a retirement account there, which probably means you have if you're in the high net worth category, it probably means you have a retirement account somewhere else, whether that be at work or with another advisor or something like that. So again, if you have a brokerage account, a taxable only account, it makes sense that those would be more extreme. So 9% of those did not invest in equities, and 17% held equity only portfolios. So again, sometimes when you look at a study like this, it's just not all that intuitive, and you think you find some really surprising things. In this, I think it's intuitive, and I also think that it kind of reinforces a lot of what we think are best practices as financial advisors, and gives, I think, people some comfort knowing that if they are following best practices, they have a lot of company. So let's talk about some products that are used in the various portfolios. Households with taxable accounts and IRAs are households that tend to have the highest balances, and households with multiple investment types. Again, makes sense. The more money you have, the more investments you're probably going to have, the more types of accounts you're going to have, the more investments you're going to have in those accounts. And if you have your taxable accounts at Vanguard and your IRAs at Vanguard, it probably means more of your overall relationships at Vanguard, right? Instead of in the 401k plan at work or with another advisor, and therefore that would be indicative, of course, of higher balances. This is sort of interesting, but again, I think it just is people's sort of need for speed, if you will. Portfolios with individual securities have significantly higher balances. Again, as you have more money and you're just looking to diversify more and try different strategies and do different things, the more money you have, the probably more apt you're going to be to start buying actual individual stocks, to actually hold your own Apple stock or your own Netflix stock or your own JP Morgan stock or whatever it might be. Those people that have individual equities who have more money tend to be more aggressive, tend to have more money allocated to equities. And then the last bullet point kind of harkens back to a question that came earlier. There's target date funds, there's single fund options, the ones that I said like target 2050 because you think you're going to retire in 2050, and the allocation is going to constantly adjust along a glide path as you get older. So the older you get, the less risky it's going to be. Those single fund options are not that prevalent among affluent households. That could change in the future. In more and more 401k plans, people are more and more encouraged, and I think rightfully so, to use those types of target date funds. And as those people build their wealth over time, people will probably keep those funds. And as time goes on, high net worth households will probably have more exposure to target date funds. But target date funds are relatively new, certainly only widespread in the last decade or so, and therefore just not that prevalent in high net worth household accounts. Well over half of affluent households have what they call complex portfolios, which means 6 to 10 investments across 3 or more accounts. And that's how Vanguard is defining complex: 6 to 10 investments across 3 or more accounts. 1/3 have more than 3 accounts and more than 11 investments. So that's a significant amount of people who have more than 3 accounts and have more than 11 investments. And again, we tend to see that too. The more money you have, the more times you have accounts for different reasons set up for different people. You just tend to have a lot more accounts. So I'll just take a quick again and take a quick breather there for a second and see if anyone has any questions.
I do, but it's 2 screens back.
We'll go back.
Okay. I don't know if can you go back to right there? All right. It's the next to last bullet point. Higher individual security usage corresponds to greater equity exposure. Could you rephrase that?
Yeah. So people that are actually buying individual stocks for themselves, like they're actually buying shares directly in Apple,
Mhm,
shares directly in JP Morgan,
mhm.
actually buying their own, 100 shares of Fulton Bank or whatever stock it might be.
It just means they have.
Going in there and buying individual stocks are tend to be more invested in equities. So the average in here is 60% invested in equities. The people that are buying individual stocks have a higher average in equities in general. So there's people that are actually going out there and buying individual shares of Fulton Bank or JP Morgan. They're going to have an equity exposure that's maybe 70% or 80%. It's going to be higher than the average of 60-some%.
Oh, okay, thanks. I thought that's what it meant. I was just making sure. Thank you.
No, thanks for clarifying.
I'm not seeing any additional hands up, but if anybody has a question, feel free to unmute yourself and ask. And if not, we'll just keep moving here. Okay.
This is kind of the last little section, and then we can take more questions or we can be done early. So this is, they actually were able to extend the study and look at what happened during COVID, just to kind of see how people would react to a extreme market or a market that was very volatile. So from February 19th of 2020 to March 23rd, in that very short, like 1 month and a few day period, US markets fell 34%. So it was a really, really fast, really steep drop. But it was also the fastest and steepest, quickest rebound that has ever occurred as well. So by August of 2020, stocks were actually making new highs again. So among all these affluent investors at Vanguard, only 1% of households actually abandoned equities completely and gave up on the market during that period of time. So very, very small number. Still a large number in the aggregate of probably highly disappointed people, but as a percentage, it was pretty small. Between pre-crisis, December of 2019 and June of 2020, when much of the rebound was already in, equity allocations across the board fell about 3%. So people probably did sell a little bit of their stocks during the crisis. That indicates, or if they didn't sell a little bit during the crisis, they definitely didn't rebalance during the crisis like you're supposed to. So definitely, as is human nature, it was a stressful time. It was an uncertain time. People definitely pulled back a little bit, and people were definitely hesitant to buy during the quote unquote crisis. Now, obviously, since then, people can't buy fast enough, but sort of the height of the crisis before we made new highs again, there was definitely a fall off, and I mean, very small fall off, but definitely a fall off in people's risk taking and people's equity allocation. Probably just trimming of portfolio positions occurred, and also people probably didn't rebalance again. That's what that would indicate to us. So that is it for the slides, and I'm happy to answer any questions. And if you guys don't have, or if you folks don't have any specific questions about this material, I'd be happy to answer any kind of general financial planning question you might have, if I can.
We do have one that came through chat. I'll give everybody else a chance to kind of think if there's something else that they want to ask. And that was just your personal suggestion as an investor. Do you advise people to abandon the market when there's a downturn?
No, it's the worst thing that people can do. There's absolutely no way to time or predict markets. No human has ever been able to successfully do it repeatedly. There's people that have gotten lucky a few times, but there's no one who's been able to do it over and over again. Thus far, there's no computer that can do it over and over again. Investment managers who try to predict the market and the direction of the market are highly fallible. So are computer programs that try to do it. It just does not work. There's a lot of hindsight bias that we all have. We see things that happen and then we kind of rationalize like why they happen, and they seem in hindsight that they were predictable, and they're not. We don't know why things happen. Most events are very, very random, and that doesn't that also includes the stock market. There's tremendous amount of randomness that occurs. Cause and effect is also not necessarily correct, and people think like if X happens, then Y is going to happen, but that's not necessarily true. If X happens, then A, B, C, and D could happen, which could make Y not happen. So, people tend to get fixated on certain things, whether it be the economy or whether it be valuations or whether it be anecdotal things or political things. But these things are not at all predictive of markets, and people need to stay in the market at a place where they're comfortable, whether or not the market goes up or down.
Would you talk about the Wellington Fund and if there's any reason why an 80-year-old should not have a lot in that fund?
So the Wellington Fund is a Vanguard fund that is a balanced fund, but it's actually highly allocated toward bonds. So it's bond exposure that is on stock exposure. The Wellington Fund is oftentimes referred to as a value fund. So they're trying to find stocks that are undervalued, that pay good dividends, and bonds that they feel are undervalued and safe. So no, it's a very appropriate investment for someone who is older. It obviously will have volatility. There's going to be times where it could go down, a good deal, because it does have a decent allocation to stocks. I don't know off the top of my head if it's 30% or 40%, but it does have a decent allocation to stocks. It definitely has risk to it, but it's a very good fund that's had a great long-term track record and is definitely not too risky, in my opinion.
Another question. I'm
I have a
sorry, please go ahead.
about indexed annuities. If you're investing in those once you're retired, would you say not to have more than a certain percentage of those in your portfolio?
A lot of people like me who are the type of financial advisor I am don't believe that equity indexed annuities are a good idea. In my opinion, the fees are very high. They're very complicated. I believe that they're ultimately low returning because of the fees. The complexity in them is pretty extreme, in my opinion. So, my opinion would be limit your allocation to those to zero if possible. But if you are invested in equity index annuities, I would strongly discourage that from being your entire portfolio.
One of the other questions.
Elaborate on that too, if you have more questions about it.
A question that came through via chat is, what do you think of investing in gold, silver, and/or Bitcoin?
I think it's a bad idea to have a small, diversifying part of your portfolio. I'm kind of playing with my dog here, so he doesn't bark. She doesn't bark, so. I think it's good to have a small part of your portfolio in precious metals. There's nothing wrong with that, like a 5% or maybe even 10% allocation, particularly to gold. Gold has been over centuries a very, very stable asset class. You don't want to speculate in it. You want it to be a certain percentage of your portfolio, a small percentage of your portfolio, because it doesn't really have any intrinsic value, right? They don't really use gold for much of anything except for jewelry. It doesn't have a lot of utility, but it is something that over hundreds of years has maintained its value relative to inflation. There's an old expression that an ounce of gold will buy you a fine suit of clothing, and that's generally been, people don't really wear suits anymore, but as long as as long as it's gone for hundreds of years, that's generally been a pretty fair rule. So yeah, gold's a good inflation hedge. It's good hedge against the market when it goes down. Sometimes when the market goes down, gold goes up, not always. Personally, Bitcoin's been tremendously successful. It's been an unbelievable investment. There's people that have made tremendous amounts of money on it. My personal opinion is that it doesn't have any value and that it's a fad, but that's just my personal opinion.
And would that be actual gold you could hold in your hand or stocks or what?
Yeah, that's a good question and an interesting one, I think. So I think if you want to, in a portfolio context, if you want to have some gold, use D, which is the exchange traded gold, was backed by physical gold. You have physical gold vaults to represent the value of the ETF. Obviously, it's not exact at any given, but it is backed by actual. I'm not a big believer necessarily in holding physical gold for a number of reasons. I think people hold physical gold sometimes because they think that like sort of an Armageddon scenario would be useful. I think that's questionable. Obviously there's security risk to it. You have to protect it and you have to keep it in a safe place and someone could steal it. I just don't see a lot of reason to own physical gold, but as a hobby or something like that, that's one thing. But as a pure investment, probably better to just have it in a portfolio context. Again, in my opinion.
Thank you.
I have a
Sure,
question.
thank you.
I was just wondering if you have any numbers about how people have done since the pandemic started, when their portfolios went down 30% or whatever you said till now. Have they come back?
Oh, yes, they've come back, quite substantially. Since the pandemic hit, a lot of even balanced portfolios are up from the bottom, are up, substantially. It's been a really big run for the market. It's been a really good run for the market. So holding on through COVID, you were basically back to even by August, and ever since then, it's just been gains. And for most people, that's well into double-digit gains at least.
Ben, what percentage of the population is invested in the market? Is it just the middle class and upper class, or do you have any statistics on that?
I don't know off the top of my head.
Well, I could send that to you via email if that's something that you wanted to look into, and maybe we could send it out with the presentation.
Yeah, let's just see what Google has to say here.
Okay.
I got to prove I'm not a robot. I'm clicking on fire hydrants. Let's see here. So, according to an article in Forbes magazine, the majority of Americans are not significantly affected. 55% of Americans own stocks.
Okay.
Stock ownership peaked in 2000 at the dot-com bubble. 67% of Americans said they own stocks at the dot-com peak. Now it's about 55% of people say they own stocks right now. So it could be up a little bit. This is about 9 months old, because it does tend to go up as markets do better and better. Like I said, during the sort of the dot-com peak was 67%. Right before the financial crisis, it was 65%. It had dropped back to 55%, 6-9 months ago. So it probably is increasing. That's what tends to happen. That's usually the last phase of a bull market, is when sort of your average investor, retail investor, starts to get into the stock market.
Thank you. And for a retired person, is it good to rotate from some of the high-flying stay-at-home stocks to more value-oriented stocks?
I mean, there seems to be a shift underway right now where value stocks are beginning to finally outperform growth stocks for the first time for the first time since the financial crisis. So 13, 14 years, growth has dominated the market. There does seem to be a rotation, a slow rotation back into value stocks over the last couple of months, actually over the last year. It's probably going to be a function of interest rates. If interest rates move up, value stocks become mathematically more valuable than growth stocks.
What is a value stock versus the growth stock?
A value stock is a stock that generally sells for a lower price to earnings ratio, generally pays dividend, and generally has lower growth prospects. So a company that might say predict itself to grow at 5% per year, sort of a stable household company, going to grow 5% per year. It might sell for 20 times earnings instead of growth stock, which might sell for 200 times earnings. It probably pays a dividend. It might pay a 2 or 3% dividend, whereas growth stock would pay no dividend. Those are some of the fundamental differences between growth and value stocks. But primarily because of the dividend component, right? As inflation rises, $1 today is worth more than $1 tomorrow. The higher interest rates are, the more that's true. And therefore, as interest rates move up, value stocks do tend to outperform over time. So I believe that interest rates are going up over a long period of time. You might be believing that this is the beginning of a legitimate value cycle, that the cycle was going to shift from, just like the dot-com craze, it was a major growth stock bull market for a decade or more that ended in 2000. And then from 2000 to 2008, it was more value stocks. And 2008 to now, it's been more growth stocks. So it definitely ebbs and flows. It also ebbs and flows between international and US. So again, leading up to the bubble in 2000, the US had dramatically outperformed. From 2000 to the financial crisis, international dramatically outperformed the United States. Since the financial crisis, the United States has dramatically outperformed international. That may switch back to at some point. It does tend to be cyclical.
Then what % of one's portfolio should be held in cash?
I'm not a big believer in cash. It just doesn't yield anything. I think cash is sort of nebulous too. It's hard to deploy. People think, oh, I'm going to hold this cash, and then when the market falls, I'm going to buy stocks. But then when the market falls, they say, oh, well, I don't want to buy stocks now. Things don't look very good. So it tends to be nebulous. You tend to get caught in this sort of cash vacuum where it always stays in cash and you just never get a return on it. And with inflation, cash eats away at the value of cash declines. So I think you should have a reserve fund, a rainy day fund, again, depending on your occupation and all different kinds of things. 6 months to 2 years of your living expenses should be in cash as sort of a rainy day fund. But beyond that, I think you should be as fully invested as you can be.
Okay. Are there index funds that are actively managed? And then the same question for ETFs. Are there ETFs that are actively managed?
So that's kind of an interesting question. So yeah, there are ETFs that are actively managed. Absolutely. Not too many, but there definitely are. But so there's a lot of now indexes that are sort of actively managed because they're called like factor funds, or they use factors. So instead of just using market capitalization, right, which is a traditional index, which I talked about before, how Apple's the biggest company in the world, so it's the biggest weighting in the indexes. Instead of using that traditional measure of an index fund, which was how index funds were invented, market capitalization, now you've created indexes around things like dividend yield, things like how a company might have performed last year, around certain sectors, around new technologies. So absolutely, there's actively managed ETFs, there's actively managed index funds in a way. Things that people purport to be sort of passive. They might be controlled by a computer, but someone's programming the computer to sort of use non-traditional measures. And therefore, in my view, it's active. They're saying, find these characteristics in these stocks and put them in this ETF or put them in this mutual fund.
Are preferred stocks a good investment for an 80-year-old as bond yields are low?
I mean, I think they definitely can be. You need to be careful. I mean, for years, people really took preferred stocks to be extremely safe, um, but and with the financial crisis, a lot of preferred stocks are in financials. Like banks have a lot of preferred stock issuance. So during the financial crisis, preferred stocks did very poorly in a lot of cases because they were bank preferreds. Energy also will tend to have a lot of preferred stock, and that's a sector that's suffered as well. So I think they can be good investments. You just have to be highly selective and make sure they're really high quality, that the companies are really good.
Ben, do you have any advice for parents of young adults aged 20 to 25 and just entering the investment world? What's a good way to start? How can they get education and guidance?
I think there's the best way to start is investing in your retirement plan at work. Try to put as much in your retirement plan at work as you possibly can afford to do. Keep it very simple. Use a target date fund. If you're 25, you're not going to be retiring for 40 years, say. So you go into a 2060 target fund. You dollar cost average. You stick with it. You put as much away into that as you can. You're probably going to do very well for yourself over a long period of time. That's the best investment advice I think you can give someone. Sometimes younger people, especially now, are really into cryptocurrency, really into like things like GameStop, things that I think are highly speculative and may pay off very, very well in the short run, may even pay off very well in the long run, but it's still very, very high risk. You just don't know what's going to happen. Whereas a traditional investment approach has worked for literally hundreds of years. You just have to stick to it. You have to be into it through thick and thin. There's a little book that there's a series of books called The Little Book of Such and Such Investing. There's one called The Little Book of Common Sense Investing by John Bogle. John Bogle actually is the founder of Vanguard. If there's one book that anybody should read starting out in investing, or even if you've invested for 50 years, and it's a really quick read, The Little Book of Common Sense Investing by John Bogle, I would highly, highly recommend it.
Thank you so much.
Sure.
Could you suggest any fixed income investments in place of bond funds, since they're not too good right now?
I think fixed income is just a tough spot to be in. I think the smartest thing you can do with fixed income is understand that you're not going to get a return, or it's going to be a very, very low return, and understand that it has a place in your portfolio and why it has a place in your portfolio, and just accept that you're going to get a very low return. The purpose of fixed income in the portfolio is to give the portfolio stability. So when the market does go down a lot, again, which it will, it always does, it's just a matter of when, not if. But when the market, I always use this like basic rule of thumb. If you're half stocks and half bonds and the market goes down 30%, you're going to be down 15%. That's a good way to gauge your risk. So if you're 30% bonds and the market goes down 30%, you're going to be down 21% because you have 70% in stocks. So that's a good way to gauge your risk. It's a good way to understand like what your bond exposure can be. How much pain can you take when the market goes down a lot? And the market will tend to go down 30 to 50%, every 10 years or 7 years, whatever the average is. It happens over and over and over again. So you have bonds in there to provide stability, to keep you from selling in a panic at the wrong time. And bonds are also in there to rebalance. So if stocks do go down a lot, you have money that you can invest and rebalance your portfolio. So if you're 60% stocks, the market gets absolutely slammed and your allocation is now 50% stocks because the market fell that far. You can take money from your bond portion, you can buy another 10% in stocks. That's what you're supposed to do. That's the most effective strategy. You just have to accept that bonds don't pay anything. And psychologically, it's very, very hard for some people. They say, why would I ever invest in something that pays 0% or 0.25% or 2%? They still have a purpose in the portfolio, even though they're low returning. And the other thing that you have to think too is internationally, most other countries have negative interest rates. So you can, even if you buy a bond that yields 0%, if we ever go to negative interest rates in the United States, you can make a lot of money on a bond that's you bought for 0% because it could appreciate, the price of the bond could appreciate. Bond prices go up as interest rates go down. So if we ever have negative interest rates, you could still make money on bonds. So I just think I see this with a lot of clients. They don't like fixed income because it has such a low return. But you just have to take a step back and realize it still serves a very, very important purpose.
I think the next question kind of piggybacks on that, and that is, with interest rates at such a low point and nowhere to go but up, do you recommend a person have their bond allocation in bond mutual funds or individual bond ladders?
I mean, I think, I buy individual bond ladders. That's what we do for our business. That's what we think is the best thing to do, regardless of the direction of interest rates. There's a number of reasons for that. But most people really just can't do that, don't really have the ability to do it. So if you don't have the ability to do it, then buy a bond mutual fund. It's fine. Just don't buy a risky one. Buy an index fund, an intermediate index fund, or an aggregate index fund. Vanguard offers them. iShares has a fund called AGG, which is the ticker symbol, which is the whole aggregate US bond market. But yeah, I mean, again, all things being equal, I would rather ladder individual bonds, but that's not always possible for people. And then the other thing I would say is I've been hearing for a long, long time that interest rates have nowhere to go but up, and the whole time they've gone down. So it's so easy to think that, and I think that this might be the time that they are going to go up, but I've literally heard that for my entirety of my career, 20 years, that interest rates are going to go up, and they've gone down, 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 down to the point where they were, for a very short time during the financial crisis, they were negative. For COVID, they were negative a little bit. So you just never know. It's easy to say that interest rates are going to go up, but they may or may not.
Interesting. That is all of the questions that I've received via chat. Is there anyone else who has a question? Feel free to unmute yourself and ask. And we have just a couple more minutes here. And if not, Ben, I want to say thank you so much. What an informative, great presentation. Thanks for all the questions, everybody. And we just appreciate your guidance and leadership so much as part of the Planned Giving Council here at Hospice and what you do for our community.
Thank you. It was a pleasure. Everyone has a good night. Thanks again.
Yeah. For everybody else, don't forget, we'll be sending out the slides and a follow-up email tomorrow. And if you have any additional questions, feel free to reach out to me and I'll make sure that those get to Ben. Thank you all so much for participating.
Take care. Thank you.
Bye.